G'day, welcome to the closing bell on the 21st of May. The excitement continues out there in the market land. We've had about nearly 8 weeks of constant selling in the US. Now, we are really reaching a point where it's decision time for the market. It's either going to snap and we're going to see some really big downside volatility, or the highest odds is probably that we see a bit of a balancing up period for a while, that it's all a bit overstretched. And, the moments when the market's going to really crash, they're pretty rare. And I think that now that we're at this point where the market's so bearish, so overextended, I think there is a heightened probability as we go along here now that we're going to see some sort of a short squeeze develop. But also, I'm going to show you that we really are on the edge. So I don't really want to stick my neck too far out right now to say exactly what's going to happen. I've been telling you for the last few months what I thought as the market was selling off. Once it started turning down, I thought the big selling was going to happen. It has happened. So we are definitely in a new environment. It's the worst start to the year for a long time in the markets. I think there's more downside to come over the coming months. But just the point we're at right now is one of those, volatility point where it can really spike quite quickly on a short squeeze. But also, if it can't hold these levels, we go into bear market territory. The selling actually can accelerate to the downside. So it's a bit of a flip of the coin over this next week or two, as far as I'm concerned. So let's just jump to the charts. I want to show you how overstretched it's looking and what's going on. So let's start with the US 10 years. This is the 10-year bond yield chart. This is a monthly chart. So when the yield is going down, the price is going up. When the yield is going up, the price is going down. So this is actually a sell-off in the bonds that we've seen since 2020. So that's the low in yields after that COVID crash. And the yields have been slowly creeping higher and then racing higher recently as everyone realized inflation really, the cat is out of the bag. So we're at that point now where we've had a really big sell-off in those bonds. And there's some data coming out, Target, Walmart coming out saying their margins are being crunched, demand starting to slow down, inventory starting to go up. So we're starting to see the effect of an inflationary environment and that these companies don't have pricing power. So their margins getting killed, so earnings going down, stock prices going down. So, we are at that point where people are starting to think about possibilities of recession over the next year. Where do you park your money? With the US 10 years approaching 3%, possibly people are going to start thinking, well, that's not a bad bet now. 3% yield, you're safe as houses there. Inflation's probably going to peak as growth falls away. So maybe we're at an overextended point with these 10 years. So, as I've said, I think it still can head above that 3.25% region. I think above there, I'm worried that it could actually become a very sharp sell-off, as in the yields really moving higher fast. But right now on the RSIs on the monthly, you can see up here in overbought territory, which is really oversold territory as far as the price is concerned. So, we're seeing some buying coming into the bonds, yields dropping here back to 2.86%, nearly creating a weekly sell pivot. So, now that it's overextended, we might just get a bit of a retreat in these 10-year bond yields. That could ignite some buying potentially in stocks, people fearing that things were going to get a bit out of control. If inflation figures start to soften off a bit, people may think the Fed's going to back off if recession's coming. We're sort of entering that sort of a period where this initial panic may subside for a bit. So I'm just aware of that. Want you to also, be thinking about that. But I'm just thinking that, some sort of balancing up, back to those moving averages. That's not saying that we're not going to have some sort of scare ultimately and that it's not going to end up doing that. So I'm not necessarily calling the high in yields is in place at all. Just saying that we may be in for just a bit of a mean reversion before the market decides what it wants to do. And that will depend on data, whether, growth really falls off its perch and then the Fed ends up backing off, perhaps, who knows? Maybe stocks will have a big leg down and the Fed will think that's enough. So that's really my view on those bonds. Now that's feeding into some other things going on out there. The US dollar, similar position on this monthly chart. I do think the US dollar is heading higher, but it is testing the top of the range for the past over a decade, nearly 2 decades, but of this range of the past 7 years, it's right at the extremity up there. And also those RSIs getting into overbought territory. So, a bit of a balancing up period in the US dollar could be on the cards. But then I think ultimately it will head higher. But just, a bit of weakness from overbought levels is how I'd be looking at this. And, that can then feed into the gold price starting to pick back up. So, gold prices where they are now, really for me is the spot where they need to find buying support. This is the long-term monthly chart for gold as well. I've shown you this before. Just to recap, there's a 2011 high. We had a spike, a huge strong rally up to 2100. And then we've had a correction over the past year and a half. And that's the interesting thing is whether, gold has just made another double top here. And then if weakness comes in, it can look really bad quite quickly, especially back under 1700. I really don't like gold. But then, I think it could be just fabulous buying if we saw a big clear out in gold like that. I don't know that that's going to happen, but just the technical situation there is that if there's further weakness in gold, it can look pretty bad pretty quickly. So the short term, though, is still bullish. If we just look up close at this and how it's moved just recently, and I'm just looking at the monthly charts, and this can be quite tricky how it plays out. If you look at the low of the correction, you'll see that we had a monthly buy pivot there. Then we had a first key bar up, which is when you get a monthly close above the high of the pivot. But then if we go along, there was actually there wasn't a monthly sell pivot. Okay, so that means we're looking at this now as the next key bar higher was actually there, which was a couple of months ago. So if, we end up creating a monthly sell pivot this month, that is actually a little bit bearish for gold. But if we're looking at the rally we've had from those lows, you'll see that the prices where it's pulled back to, this is a monthly chart we've got here. So this is the last couple of months, we've had a big sell-off. You'll see that it's pulled back quite close to the buy zone of that. So it's still in an area where it can find support and ultimately turn back up. But it has been, quite weak, surprisingly so. But I think that's real rates heading higher and everyone thinking the Fed really is going to chase down inflation and raise rates. So people are a bit nervous about gold, which is understandable. But the technical picture there, even though it's sort of short-term bearish and could turn monthly bearish, it is just at a spot where it could really bounce from. So I'm interested to see how gold performs as the US dollar's selling off. That will be supportive for the gold price. So we may be just in for a bit of a bounce in gold, and there was quite good strong buying across the gold index in the US, and our gold stocks very beaten up at the moment. I actually dumped a bunch of gold stocks recently. And look, I'll be keeping an eye on the gold price to see whether it's time to jump back in. But I am a bit wary of gold. I don't have a very strong view either way. So just finishing up with the Aussie dollar, that US dollar obviously a bit overbought, turning down, and our Aussie dollar, you'll remember I had a target of 68 cents or 68.3 cents being the midpoint of the last major wave down. And we did see a move down to that area. Look, ultimately, I think Aussie dollar could be heading lower, but we're just a bit short-term oversold, similar to that US dollar being short-term overbought. So, it's gone and hit that target, hit the point of control, and is attempting to have a little squeeze here. So maybe in for a bit of a mean reversion move, and then heading back down. And back under that 68 cents is quite bearish for the Aussie dollar, with targets down towards 62 cents. But, just a bit of a feeling of a balancing up time. Things a bit overstretched at the moment, 8 weeks of selling, or 7, or whatever it is in the US in stocks. We haven't seen that for decades, that sort of a strong selling period. So it's either at the point where it's going to snap and you're going to see it plummet below the lows from a few weeks ago, or it's time for a bit of a short squeeze. And look, I'm sorry, I'm maybe not adding that much value to you today, but that's just the situation in the market for me. You've either got the positions on. I've been telling you for a few months to beware, so you should be prepared for the market to really snap. But we need to see a few more signs before I'd get bullish, and we could say that the short squeeze is on. But I'm just nervous. I wouldn't be out there shorting the market at these levels, that's for sure. So it's a bit of a watch and see week, I think, coming up. All right, well, that's all I've got for you today. I will come back with more next week, and check out what I'm doing at Pivot Trader and Fat Tail Microcaps, and come along and trade with me. That would be good. All right, cheers. I'll come back next week.